Robert, greetings. Welcome to the Meeting Podcast. You're currently in New York. How's the week been treating you?
Week's been pretty good. It's been a busy week. It feels like I'm not sure if I'm getting older or the weeks are getting faster, but it sure does feel like there's a lot going on. It's been the weather's changed a lot in New York this week as well. We had some cold spells, warmed up enough to get outside, hit the trails a little bit, and then now it's back to, I think, in the 20s in Fahrenheit. So I thought I saw some light dusting of snow. But that's how it's been. How about you, Jeff?
Yeah, it's interesting times here in Sydney. I think the man upstairs, so to speak, is a bit angry because we've been getting a lot of rain.
Yeah,
I mean a lot.
Really?
I think so. I'm based in Sydney, and I think it's been more than 50 years since we had so much sort of rainfall hit the land.
That's a good thing, yeah, because I think I think you've been needing some rain over there. Yeah,
it's always a bit tricky when you try to find a balance between, you need enough to sort of for the agricultural land, replenish the soil and whatnot. But the downside, of course, is that you're getting floods.
Or is there a lot of flooding as a result?
Yeah, there's a lot of flooding.
Yeah, that's typical in life, right? It seems to be either too much or too little. Never the porridge is never the right temperature. I think is how that goes. But
I think there's no sort of right and wrong in terms of too much, too little. It is what it is, eh?
Yeah.
In terms of how it all works.
All right.
So we'll see how we go. We're to keep it positive. Thank you for filling in your responses. Don't mind me. I'm actually going to quote it word for word because it's very interesting. Making your job, investments, lifestyle work for you is more than possible than ever. Tell me, what do you mean by that, Robert?
Well, I think that this sort of post-COVID period has come as a shock and a change to a lot of people. Some has been sort of a little bit direct, some has been indirect, some has been a little bit sort of expected, and some has been not so expected. And I think one of the big things has been lifestyle changes. So let me ask you this, Jeff: do you think people are more free or less free now? I mean, maybe more free in that they're not going into the office, or maybe less free in terms of some of their kind of movement around. But I think that also, with everyone working remote, there's a variety of sort of side hustles and setting up virtual businesses. I mean, look at us here today. And I think that when I say, for instance, that that you can create more freedom, I mean that you can kind of almost have a mosaic of different kind of income streams and things you do, and you can maybe better match that to what your lifestyle and life goals are. For instance, I believe you're on the early part of a journey with some young ones. Mine are a little bit older, and I came up on WallStreet, missing, leaving the trading desk to go to a parent-teacher conference. That really was not a thing, 15 years ago, 20 years ago. No, 100%. So a lot of people maybe closer to, that have spent 20 years in the market haven't really seen the market so friendly to people. It used to be a lot more FaceTime, like, if you're not in, at 7 a.m. for all day, then other people will be. So I think that a lot of people kind of sacrificed being around their family or doing some things that made them whomever they are or whatever they wish to kind of achieve. And then maybe some people had longer commutes, and so on. So I think in some ways maybe it restricts freedom, but I think in a lot of ways, maybe it enhances freedom in the sense of that you're not such a slave, maybe to slave, I use as a figure of speech, not so restricted in what you can do, with just one sort of job, like all your eggs aren't in one basket, so to speak. That's what I mean. Does that make
Interesting,
sense?
interesting. Yeah, no, definitely, Robert. And have
Mm.
you personally yourself been trying to create those different streams? I know you and I, we've been talking about you starting a new firm. Um,
Yes.
have you yourself personally realized that obviously your kids are a bit older than mine? Um, Obviously, starting this new firm, does that give you that freedom going forward that you want? Or
Well, like any new firm,
mm,
my hope is that it will eventually. Yes,
yeah,
right now it's sort of,
mm,
you're throwing seeds in the garden, so to speak, and it takes a bit for it to grow. But yeah, 100%, 100%. And also, I'm driven a little bit by a sense of empathy, and I feel like I personally that I spent 20 years on Wall
yeah, it's a
Street,
long
spent
time.
a lot of time, a lot of time during the week, a lot of time not necessarily there with my kids, or also with
Mm,
my dad's in his 80s. He's still working, and he needs to do that because for a variety of different sort of obligations. And I feel like a lot of people sometimes do what they feel like they're supposed to, and just sort of put their money with an advisor or whatever. And my dad was saying that that's exactly what he had done, and things didn't quite work out the
oh,
way
wow.
he wasn't quite getting what way he wanted, and so on. And so I do feel like, and
Mm,
interestingly, here I am in New York, and financial services generally is kind of a shrinking industry. So there's an excess of people. Um, and it's interesting when you go to other places around the country, or really the world, those skills that are in abundance in New York are really valuable. For instance,
mm,
where in Florida, commercial real estate is really booming. And so there's a lot of people, really, really smart people, that I respect very much. And then they've asked me questions like, is the market rigged, or is this and that, and like that. That,
you mean
that
Wall
just
Street, Robert, or do you mean the commercial real estate market? Sorry.
no Wall Street, just implying a lack of specific understanding. But I guess that's true, right? People specialize and so on. So I realize there really is a need, for this type of thing. And so that's when,
Interesting.
and for instance, rather than me, when I was going around as a trader, and you put together your CV, and you basically your CV. I mean, what does it say? I'm so good at doing this. You guys should hire me.
Yeah, I'm the best. Here are my accolades. Here are my
Yeah,
responsibilities.
yeah,
I've got referrals from X, Y, and Z. You should bring me on board.
exactly right. And
Yeah,
then, but then I was thinking, geez, if you're so good at doing this, then you
do it
should do it for
yourself.
yourself.
Love it.
Yeah. So that kind of set me on a path, and with that, um, the guardrails go away, so to speak. In terms of the structure, of of working for someone else. But with it comes, a lot, the ability to sort of execute like a vision, and do things, and create the culture that you want to. And I want to create a culture of really trying to help other people. And the way that I can do that is, I mean, geez, I wish I could sing, I wish I could dance, I wish I could draw, but what I can do is, I can invest, and I know the market. So that's sort of my platform, I guess. But yeah, so that's what I'm doing.
Beautiful, Robert. It's funny. It's funny when you mentioned that you want to, so essentially you want to create a business where you can create a culture that really is a bit more empathetic towards the employees, so to speak. Is that correct? Or
Yeah, employees, but also clients, for sure, for sure. I think that people are looking for
mm,
a couple of things. I think people are looking for, one, a better way. Two, I think people want to be educated, and understand the market. And I think that, it's really interesting. The financial markets have grown up and developed according to how businesses provide services, and how, these industries are regulated, not necessarily how customers use the products. Like, for instance, let's just
interesting.
let's
Good.
just take yourself, or your father, or your mother, or your sister. I mean, do they necessarily need a separate insurance person, a separate crypto person, a separate mutual fund person? Probably not. They really just need kind of a trusted advisor. Um, and it's just how that industry has been kind of set up. I find it kind of interesting because my background's always been from the Wall Street institutional perspective, and
Mm,
taking that perspective and thinking about it for families and so on. It's been really interesting. And,
Interesting. Wow.
yeah.
So your firm, you're thinking about providing more of a holistic solution, so to speak, where, John Smith can probably a high net worth individual, for example, goes to your firm. I have X amount of money. I want to go property, crypto, shares, bonds, alternative investments, for example, art, classic cars, for example. And you can provide that service where instead of going separate individuals, you can provide that shop where that individual can go, Robert, here you go. Please help me make the right decisions in terms of my investment decisions. Is that correct? Or
Yeah, that's correct.
brilliant.
Maybe
Love
not
it.
maybe not necessarily every one of the items that you mentioned, but broadly 100%. That's absolutely correct. Yeah, and I also think it's holistic, but it's also the ability to tailor. I think more now than ever, people really care where their money's going and what they're doing. People really care about social change and having a positive impact, and they want to tailor their investments in a certain way. So I think we've come up with a way to do that that's maybe more tailored than our other options that are out there. And then also another way that a lot of institutions, remember my background is working for the larger institutions. There's a lot of sophisticated techniques that are used at hedge funds and institutions, where I've worked before, that I think can be leveraged and employed to help individuals. Like, for instance, the use of alternatives. Are you familiar with alternatives?
Alternatives in terms of asset classes, or
Yeah.
For example, I know there are a lot of hybrids. I know there's sort of. Do you mean there's alternatives in a sense of maybe more exotic instruments, or?
Yeah,
Or
that's a really, Jeff. That's a really good question. So people will classify it really in terms of traditional, which is your stocks and bonds. And remember, the advice that most people have been given, throughout their life has been, or the traditional advice is 60% stocks, 40% bonds, right?
I think that's been turned upside down.
It's been turned upside down, right? Because what's happened, stock valuations are high, bond yields are low. So and there's been a lot of central bank stimulus, which is really skewed. So a lot of things. Now we're finally starting to see inflation. So it's a much more complex world. And I think that the traditional, so to speak, correlations of, stocks go up, bonds go down. And the reason why you have that 60-40 split is because they're offsetting in some ways, and they're kind of a natural hedge to each other. So in the absence of that working, what institutions do, is they'll come up with what they call alternatives, which are ways of creating pools of investments that have characteristics that would overall enhance either the return or or reduce the risk for a portfolio. So they lack correlation to the broader market. Well, I say lack correlation, that's a positive. Because think about it this way, Jeff. One of the I won't go so deep into finance.
No. I love it. Tell me, yeah.
But there's this notion of modern finance theory, and there's a couple theories around modern finance theory, but one of them is that with the idea is that a rational person would not want to have more risk than necessary. As risk goes up, return kind of goes up. And so there's a lot of ways where you can reduce your risk. And so it's assumed that people would do it, like, for instance, one is called diversify. And basically, the idea is that if you have all your eggs in one basket, there's, call it what you will, but this notion has been around for lots of human history, right?
I still remember studying it back in uni, back in 2004.
Yes. Well, and then it came out a little bit before that.
Yeah.
And so they say that roughly around 25 or 30, members of the portfolio really kind of achieves the max kind of benefits, not the max benefits, but the trade-off where the additional diversification is there's a falling off of benefit.
Sort of an optimal level, so to speak, in a way, or?
Yeah, that's right. The marginal benefit is increasing less. So think about it this way, Jeff. So you have 25 different assets, right? What's really implicit in that 25 line items within the portfolio. What's really implicit in that is that they don't all move in the same direction. Let's just say, for example, 25 different assets, and they're all crude oil contracts that happen to be struck at different like wellheads, around the U.S. I mean, so how do you think that's going to move? It's going to move 100% with the direction of oil, probably, right? So it's not really very diversifying. So that's the notion of correlation, meaning that, for instance, and correlation is kind of interesting because it varies too. In times of panic, they say correlation goes to 1, which means that I
think that was the case.
Whatever we can.
Whatever we can. I think we saw that recently in the past month, the whole sort of Ukraine-Russia thing. I initially, sorry to cut you off, Robert.
No.
Yeah, cryptocurrency. Yeah. It's no correlation whatsoever. But like what you said, when we had the panic about a month ago, when I think it was about Feb 24, when we had the whole sort of war thing.
Yeah, it's interesting. Isn't it interesting, Jeff? I think you bring up a really good point. People will say, oh, there's no correlation. There's no correlation. It's offsetting. You know why they say that? Is because that's just what they think. And it really hasn't been, there's a lot of people that go around and say,
they don't question. They don't question.
Yeah. Yes, they say what they think, and okay, that makes sense. And I find that sometimes the people that are the most confident, not always are the ones that are the most, well informed about what they're talking about, for instance. And so, you can say, okay, well, this is a different asset class, crypto. It's a digital asset class, stocks, different asset class. But I think if you take a step back and then you look empirically at what happened, you start with the results and figure out how do you kind of retrofit. I think it's not whether they're, a traditional asset or a digital asset or whatever. It's that they're risk assets, right? There's certain risk assets that when the market's feeling good, the skies are sunny, these assets tend to do well. Biotech, crypto, tech, these type things. Yeah, exactly. Right.
Yeah.
And then there's other things that when the market's not doing well, like, when you want safety from the storm, flight to quality, all these type things. And so I think when you think about from that paradigm, if the market's concerned about risk, of course you'd see stocks go down. Of course you'd see crypto go down at the same time because they're the riskier.
Despite the fact that on the surface, they're saying, you know what, we've got to remain calm. We've got to be rational. We've got the 60-40 split. What's interesting I find sometimes, Robert, is that everyone's rational when you're speaking with them. Everyone's rational when you're writing a research report. Everyone's rational when they go on CNBC, they go on Fox or whatever, and they go, you know what, this is what you should do, 1, 2, 3, 4. But when that person is in their study room, looking at their portfolio, I don't think they're rational anymore.
No, it's interesting you say that, and you say that from you say that from the retail perspective. 100%, you're right. Even from the institutional perspective, I've worked for large global hedge funds and banks and institutions, and friends of mine have created their own hedge funds. They're talking to me about when they're personal trading. And I'll tell you what, a human is a human. Is a human. And,
human is, mate, that is the perfect quote. A human is a human.
And so you have these notions of fear and concern and
FOMO.
Yeah, exactly. But it's really easy to say, I found in a couple of instances, it's really easy, the way you can, that's why risk management and sizing and all these things are important, because once you get to the point where you start to fear, if you're going to be able to put your kids through college and these type things, then you start acting less rationally. So you try and set processes and define things such that doesn't happen through sizing.
Sort of risk parameters, load allocations. You're saying when there's more fear, people become more rational. Is that correct?
No, the opposite. Irrational.
Irrational.
Yeah, irrational.
It's true.
Yeah, 100%. I've even seen it at large
institutions.
Yeah.
Even institutions who might have an investment committee, they act like a retail investor, so to speak. Or
no, well, I think in that instance, maybe you're putting words in my mouth a little bit. I wouldn't say that they act like a retail investor, but what I would say is that every human, whether you're representing an organization in the retail, or whether
Mm,
you're, whether you work uh, representing an organization that's part of an institution, or your retail, um, when there's fear and uncertainty in the market, it impacts everyone.
interesting.
You'll even see like large institutions, they'll decide, okay, we don't want to be in this position. They'll move out, and then you have large technical pressure if you have a large seller, and so on. 100%. The other thing that, like, for instance, what people do, I spend a lot of time thinking about decisions and decision analysis, and these type things. I find that one, so I can get better,
Interesting.
my own self. And I find that one thing that people do is, when they enter trades or when they enter investments, when they think about anything, they're like, okay, this makes sense. Sheet of paper. Let's just say even a couple buying a house, or you're investing in some kind of hedge trade, or an arbitrage, or anything that, when you look at it over a time horizon and model it out, it works for you.
Mm,
What happens is, I think that people just assume, they look at the beginning, they look at the end, and then you get your MPV, your IRR, whatever the case is. But what you forget is that it's path dependent. And remember, I said all the humans along the way. So what happens is people get shaken out because the past. So that's why there's a lot that goes on. The notion is, on the retail side, you can have more swings, but on the institutional side, there's like so much effort is put towards like dampening that volatility, and
along the journey.
along the journey, because a lot of time, if you have like some zigs and zags along the journey, a lot of people
Interesting.
get shaken out. You know what I mean? You never make it to the end to realize those sort of returns.
Interesting. So it's
Um, yeah.
okay. So as you're that's actually an interesting point. So you're right. So if one were to buy a house, they look at the facts in front of them. Um, they might look at sort of potential capital gains, rental profile, and whatnot, and then they see a time horizon of maybe 10, 15 years. Okay, I purchased a house. But from an institutional point of view, they manage that journey in terms of, risk parameters. How do we sort of smooth it out so we reduce the risks going forward? Is that correct? Or just want to make sure I understand
Yeah,
there.
yeah,
Yeah.
yeah. So you're right. There's kind of two thoughts there within the example of the house. It would be like, if you look at the house, and for instance, you look at what the comps are and what you think you can improve it to, and you do your math and so on. All of a sudden, you get in there, a couple of setbacks, and then there's a big setback you didn't expect, which is there's termites, and that's kind of
Mm,
more of a setback than you expected. And you can probably get a loan or figure it out, but a lot of times people are, all right, you know what,
forget
all
it.
right, that's fine, I'm out, I didn't
Yeah.
expect that, I'm out. And that same mentality, in a different way, I'm kind of trivializing it a little bit, but that exists in a lot of ways. Is that, and that's
Interesting.
why I say something is path dependent. If everything went according to the model,
Interesting.
then that's fine. But what I've noticed is that when things deviate too much, people are very quick to hit the reset button and be like, all right, this didn't work, get out. And that creates lots of human emotions. You said FOMO, all these type things. But it's interesting. So I
So
think
how
that so much is path dependent.
so how would an everyday person try to manage that? Because that's a very interesting point. Like, dare I say, I've gone through that.
Yeah.
How does
Well,
one manage that? An everyday person.
well, I mean, what they typically say is it's helpful to have someone else, help you do
Interesting.
that. And the reason is not that a person can't do it. It's not that, external advice is by necessity, smarter or anything along that line. But sometimes um, the way that you try and manage that is by not being overly emotional, and sometimes it's hard for people to do that. Let me give you an example of my dad.
Interesting, Robert. Very
COVID
interesting.
COVID happened, and he's like, "Oh my God, too much volatility. I gotta get out." He's like, "Okay, fine, get out." So he's out. I'm like, Dad, I don't know, man. It's kind of like the lows here. Okay, fine, no problem. And then like a couple months later, I'm like, Dad, I did a lot of work on energy, and the whole thing is like, I know we're going to sustainability, but the whole thing is, a lot of these companies have been distressed and they're pulling back on their capital spending. So like when you look at sort of the decline rates and all this kind of stuff, I mean, supply is going down. So supply is going down. And then I didn't know that, I mean,
because of the underinvestment.
Yeah, the underinvestment. It's a natural thing. That's the invisible hand of things, you know. It happens with commodity cycles. Actually, how I learned it was studying metallurgical coal over, you know, in like Australia and so on, and these cycles. But yeah, you have periods of, you know, boom and bust. But yeah, 100%. But anyway, so in that example,
yeah, getting back to your dad, yeah.
And I was like, okay, we need, you know, in this specific time, I was like, okay, it was ExxonMobil. I was like, we invest in ExxonMobil, that like 10% dividend. Doctors, brokers, like, no, I can't do it. I can't do it now. Now's not the right time. The times when things are, if you do what everyone else is doing, you'll get kind of mediocre results. If you do something that's away from the crowd, chances are you're either going to be a genius or a failure, but you're going to be something. So I think that's true of investing. And so if you do exactly what everyone else is doing, you'll get kind of the same results, which are kind of mediocre. If you think differently, actually, you know, yeah. And so for instance, and back to the example of my dad, it was too much volatility, he got out, and then all of a sudden it goes up, and he's like, oh my God, I missed it. He's like, I can't wait any longer. I put it in a CD. I'm like, isn't that like 0.1%? He's like, at least I got 0.1%. I'm like, that's like an hour of volatility. And yeah. So the point is that yeah, he works for the government. He runs a team. He's incredible. He's a wonderful career. He's incredibly smart. He's done a lot of amazing things. So it goes to show that the emotions are not a smartness thing. It's not related to intelligence. It's just related to your ability to handle uncertainty, things that are out of your control. You know,
is that decision-making process you talked about initially?
Yeah,
how you were interested in about.
Yeah, and so for instance, for a lot of people that can be too much. You know, some people really love it. Maybe they love it a little too much. But yeah, so that's generally how it works on the retail side. On the institutional side, it's much more structured, and there's a process, and there's teams, and there's mandates, and you know, and so on. But yeah,
interesting.
I guess we went a little deep on this. Sorry.
No. You this is very interesting, and I'll be lying to you, Robert, if I knew. I don't, and I really appreciate the gaddiness of it all. And yes, it is deep, but it is what it is. So getting back to the whole sort of retail mentality and the whole decision-making analysis, how does one manage emotion? How does one sort of keep themselves in track to go, you know what, I'm not going to be shaken out? How do I apply institutional techniques and frameworks to retail investing? Is that possible?
You know, yeah, it's interesting you say that. I think it's possible. It really isn't done much currently. The way it happens kind of currently is there's centralized, you call them wirehouses, you know, that would be like, not to throw out any particular names, but kind of the larger brokerages, you know, or whatever, you know, you have financial advisors. They have like a centralized model. The way that a lot of it's done is through ETFs. Do you know what an ETF is?
Yeah, it's probably one of the fastest growing sort of types of securities here in Australia. A lot of younger generation of traders / investors have really piled onto the ETF market here in Australia. Yeah. So you've got literally every single thematic covered by ETFs here in Australia, and a lot of flow has gone into ETFs. A lot of retail has moved there. A lot of retail sort of high net individuals, so to speak, go, you know what? If a large fund manager in Australia can't even you know, outperform the ASX 200, for example, why am I giving my money to them? So what's happening here in Australia is that a lot of funds under management held by these big fund managers here in Australia are seeing drops in their funds because a lot of people are taking that money and moving it to the ETF. Now, obviously, from a fees point of view, it's greatly reduced, right? Why am I paying a premium to get a fund manager to achieve, plus, 100 basis points above the ASX 200 total return when I can put my money into an ETF?
Yeah, agreed, 100%. Yeah, I think that trend, that's a trend that I think has been felt, in other regions as well. And I would broadly call that, that's kind of going from mutual funds to ETFs or exchange traded funds. I would broadly call that the shift from active investing to passive. Yeah, 100%. And I think that there's been some firms that have done that really, really well. BlackRock, for instance, has really done a great job.
Yeah, Vanguard. I think Vanguard's doing a great job.
Yep. Yeah, that's right. Yeah, you're right. You're right. You're absolutely right. You do know a lot about this.
I went pretty deep. So I started out in an options trading firm about 13 years ago. Let's be honest, I wasn't very good. I put it out there, right? So no, I'm not that good. And I realized it over time. You realize that, I'm much more, I like to believe, a bit more commercially savvy. I like to spend my time. I just do not have that mental arithmetic to be a trader. And I got to be honest with you, Robert. But over time, I realized that my strengths, so to speak, because I'm still learning. And as you know, the markets are very humbling.
Yeah.
You go, yes, I picked this great stock. I'm a genius. I was contrarian. I'm up 2-3x. And then you realize that, there was these valuations have come down maybe 10, 20, 30, 40%. And you go, you know what? Maybe I'm not such of a genius after all. But then you sort of realize that, you know what, you really got to think long term. And it's very humbling to realize that it's very hard to beat the market on a consistent basis.
Yeah.
And that's my lesson for the past 2 to 3 years, investing on my own, really looking at the numbers, really paying attention to financial statements, because that's what I'm good at. And then I realized that I got to leave it to the experts. I can't manage my emotions when things go down. You got to be honest with yourself. And I go, you know what? Am I better off putting 100, 200K, for example, with a dedicated fund manager who invests in certain thematics, and they can look at it day by day? I'll stick to my day job.
Yeah. I think got to be honest. Yeah, that makes a lot of sense the way you describe it, 100%. And I think that people's objectives might be differently. If you're swinging around 2-3x, and that's probably not how a typical average manager might do for you. It's a little bit more conservative, but 100%. And the other thing also is, I find that sometimes people like to think about things like, hey, I could do that. I could figure that out. I mean, maybe an example is, okay, maybe you hire a lawyer, you can't figure that out, or maybe you hire a doctor, you can't figure that out. But well,
how can it be? How hard can it be?
Yeah, exactly. But I mean, it's funny because I get so focused on some of this, but my dad sometimes will have observations. It's kind of funny because he's like so far away, removed from everything. He's 83 years old, so he's kind of,
Yeah. I'm still taking lessons from my dad about how to invest.
But I mean, let's just say, for example, that let's just say, for example, like you change the oil in your car. Can you figure out how to do it? Yeah, you could probably do it, but it's easier just to take it to someone. And so when I was staying, with COVID, I was staying with my dad a little bit. I was trading, and he's like, I see now how you do it. You're just looking at the computer all the time. When it goes up, you're selling it. When it goes down, he's like, well, if you're looking at the computer all the time, you know what you're doing. Of course, you can make money. I'm like, well, but Dad, I think that's kind of the point of it, right? I mean, that's kind of, he's like, okay, but so I mean, it's not. In some ways, people are like, oh, well, what means that you have all the answers. It People have experience and skills, and I think there's an art to it, and there's different processes and so on. But it's also just being dedicated and focused on it. And I believe that a lot of things. I've learned a lot about life through the markets, because there's all these notions of like where there's a will, there's an A, and effort and all that. But when you're investing a portfolio, no one says, all right, let's not even look at how much my account is up or down. Let's just ask you, how many hours did you work last weekend on preparing these ideas for me? No one will ever ask you that. No one cares how much effort you put in. They
No,
only care about the result.
like what you
So
said,
that's
right?
changed my perspective. Yeah. Anyway.
If the duck in the pond, right? You got a duck, this duck is sort of paddling in the water. No one knows the little feet just going.
Yeah. Yeah, exactly. Exactly.
And
And yeah, and people are more focused on the outcome. So yeah, no, 100%.
because you can measure it, Robert.
Yeah.
You can measure it as a percentage gain. You can measure it as a mark out of 100, for example. It's quantifiable, right?
Yeah, that's right. And then another thing that I found, it's interesting, you're talking about, gains going up and down and passive versus active versus passive. There's a couple other key key dynamics that are happening. And of course, we were talking about some of the correlations and so on. But it is interesting that there's a couple other dynamics, and one of the other big dynamics is that as financial services are shrinking, there's fewer and fewer people.
Yeah, sorry, why
that
do
are
you say that?
advertising.
I thought that industry would be sort of going gangbusters, crypto's coming up, that brings in a new sort of group of traders and analysts and researchers. Why is it shrinking? So sorry, Robert. Yeah, it's a very interesting
Yeah,
point.
no, that's it's an important question. It's shrinking because automation and juniorification. And so what I mean by automation is, let's see how to put this. There used to be this notion of like equity sales traders and treasury market traders and FX traders and probably the old swashbuckling days and for instance, all these equity sales people and so on. You don't have any of them anymore. Like 4 or 5 years ago, when I was managing a large global portfolio of high yield bonds and we we're hedging some treasuries, and I was trying to learn a little bit more how to do that. I called around all the desks like Goldman, Morgan Stanley, Citi, and I was like, I need to talk to a treasury trader, and they're like, Rob,
Where have you been?
they're like, you're a genius at high yield, but dude, they've all been fired for like 10 years, man. Like seriously.
Wow.
So I mean, maybe not quite that bad, but so the point is that there's a lot of automation, and that's the ironic thing. I think that's the mystery of life, that once you spend 20 years learning how to do something, all of a sudden you're
obsolete.
You're obsolete, and it's either computers or people that are like, I mean, so many times. Yeah, no, 100%. And so that's what's happening. It's not the size of the financial markets are shrinking. It's just the number of employees are shrinking, and that's to keep, there's a squeeze in margins. I mean, what's been happening broadly on the retail side? You have Robinhood, who's giving free commissions, right? On the institutional side, you have margins that are just continuing to squeeze down and squeeze down. You have endowments that are pulling out of hedge funds because of higher margins. So there's a real compression on margin, and so as a result, what happens? I think 2/3 of banks' cost of goods are people. So you squeeze on the people.
It's a fixed cost.
You either squeeze it. Well, it's a variable cost when you cut heads.
True.
And so yeah.
Don't say that. Don't say that.
No, but that's generally how the industry works. It's like
true.
it's a multi-decade process that's been going on. And then what happens is it's like a trend. And then there's blips like 2008, where all of a sudden there's like a big shock. And then just what happens is just not as many people come back from the shock. That's kind of
Interesting.
how it is. So that's why I say it's shrinking. Also, maybe it's just relevant to the fact that I have 20 plus years of experience, and at that level, it's kind of shrinking a little bit too. But increasingly, things are going more and more, automated. And I've even found, as I've launched a firm, I've even found that in the past, when you needed like large staff and back office and settlement teams, you can do a lot of that now virtually, a lot less expensive. And so it kind of opens up, I think, the playing field for there to be more boutique style investment firms, because the larger firms, increasingly, the minimums to have a human advisor work with you keeps going up and up and up. And that's why, how do you work with your clients? You either have a human kind of reach out to them. Generally, that's more high net worth,
Correct.
or you have a technology enabled solution, the robo advisors, or these type things, or do it yourself.
Trying to personalize it to the masses, so to speak.
Yeah, and that appeals to I think younger generations and millennial and Gen Z and so on. And I think it appeals to people like do things that themselves. And I think that the personalization is amazing. I mean, what Facebook can do in terms of personalized and targeting is so good that it's too good. And so Apple had to, yeah. I mean,
and Apple cut them off.
Apple cut them off, yeah. And it's not because they were doing something bad; it's because they were too good at it. Anyway,
that social media is sort of another topic altogether. We've got to say for another conversation. So you mentioned, Robert, there's automation. And sorry, what was the second one? Sorry.
Automation. Oh, and then there's a general trend towards, just hiring younger, and so on, and training people up and so on. That's just a constant.
And I think they sort of go hand in hand. If we're automating quite a lot of what we do, we can therefore bring in a junior person who can more so, sort of work with the technology to create that scale, as opposed to bringing in someone higher.
Yeah. That's the idea. The thought process also is that junior people are less expensive, but as you've seen, the bidding up of junior people in their late 20s, or at least on Wall Street, Google around, their salaries are being bid up to the level that's not that different from the people with much more experience. So,
interesting.
Yeah.
Wow. So
anyway,
so getting back to active versus passive, Robert, you mentioned there were quite a few considerations also.
Yes, active versus passive. There's a variety of different considerations. Generally, what the larger, I was talking about the fee pressures and some of the pressures on individuals. You're asking how that changed, but the size of the market is increasing, and the complexity of the market is increasing, and the correlations of bonds go up and stocks go down, that's not really working anymore. So what the larger institutions are doing, again, us looking at the larger institutions and learning from them, is they're employing things like alternatives. And alternatives might be examples where you get enhanced yield, or you can employ margin in certain ways, or you have long short market neutral, or you have access to different kinds of strategies. A very popular strategy now has been looking at private markets, and sometimes you can access this through alternative investment.
Interesting.
And institutions can do this because they do it, with large hedge funds and pools, but it's really not that available to individuals. Yeah, which is something that we're working on providing. And you might say, okay, well, what's the big deal about private markets? Well, think about this, Jeff. If you have central banks all over the world that are, first of all, they're printing money, and okay, we couldn't get inflation for a long time. Everyone was fussing at the banks because they couldn't make inflation. I don't know if you recall that, but it was only a handful of years ago. Now all of a sudden they're making too much inflation. So it always kind of swings around. But when all this money has gone into public markets, what's the essence of what they're trying to do? They're trying to incentivize risky behavior. Not risky behavior. They're trying to incentivize behavior of reaching for more risk, investing more in the market, and so on. Does that make sense?
Because of the inflation is going up, hence the return. Is that what you mean to differentiate?
No,
Or
no. So when the central bank, when they stimulate the market and when they
yeah,
print money, what they're trying to do is, because they're trying to do that because the market has slowed down, right?
got it. Stimulate growth.
Stimulate growth. That's why they're doing it. I mean,
Got it.
it's not because, like, hey, dude, let's go to the club and let's, print
Let's
a
go.
bunch of money. Yeah, they're trying to
Got it.
stimulate. So what's the mechanism in which they stimulate growth? Well, there's more money out there. Well, there's two ways. One, you lower interest rates, so you're not going to make any money by keeping it in the bank. Might as well go invest it.
You've got to
But
go up the risk curve.
what about when you already get to that zero bound? What do you do then? Do you do negative rates? Well, they did in Europe.
I thought New
What do
Zealand
you
was
do
talking
then?
about it as well. Yeah, what
Yeah.
do you do then? Yeah, what do you do then?
Well, what they did, quantitative easing, QE. So you increase the money supply. And for a long time, that did not increase inflation. And the reason why was because banks were hoarding it and, and boosting their reserves, and they weren't really lending it out. So then you have the notion of non-bank lending, which is asset managers and so on. I'll get to that, but that's the private market. So the bottom line is all this money is being printed, right? And they're trying to stimulate the market. And that didn't quite work because the banks were saving money. We're saving that money. And then what happened is what you want to do ideally is you want to get this money in the hands of investors so that they'll go out and they will invest in new projects and new growth projects and new capital spending projects, and the economy will grow.
Increase the pie.
Increase the pie, but in the sense of that you have to spend money to make money, or let's just say you want people to come to Sydney, and you want them to come stay in a hotel, come to a convention center and do some conferences, and and maybe work in a corporate office there or build a factory. You need to have money to build those buildings.
Build it up.
Right. So you need people to want to take that risk. The way it works in a capitalist society, if you work in a communist society, the central government says, hey, we need a building here. You people go build it. It's said, it's done. The way it works in capitalist society is they say, all right, we assume that you're looking for a return. This will be a good return for you.
If we lower the cost of borrowing for you, right, you're more likely to create that factory.
Right, 100%. So that's
you're going to hire people. You're going to create jobs.
Yes.
From an economic growth point of view, you're increasing the pie. There's more jobs. People are happier. We achieve full employment. Wages go up. Happy days, so to speak.
Right. And then how does that get paid back? Well, when there's more jobs and there's more taxes, then that taxes come in. And that's called the invisible hand of government. That kind of
interesting
thing. So what happens is that's generally how that kind of thing is supposed to work. So what happened is, post-COVID and, a couple other instances, governments went in and they were buying direct securities. In the US, for the first time ever, the Fed went in and usually how they'll do their money market operations will be through buying treasuries and, government-related securities, but they went and bought corporate securities. And Europe had been doing this for a while too. So this is really important, Jeff. And the meaning of this is, and the government will come in and they'll buy. Think about this as like a continuum of how risky it is. The government is the least risky. And then like really large corporations are, just a little bit more risky. And then smaller risky corporations are even more risky, et cetera.
And then it goes up.
It goes up. So like, for instance, when the government, they buy the treasuries or, the government securities, then they start buying the investment grade companies. And then they start buying, for instance, some of the high yield companies. So what happens is when the government comes in and starts buying, and this happened in Europe as well, specifically with their investment grade high yield market, when the government comes in and starts buying, they crowd out private investors.
Interesting.
And then so these private investors that get crowded out, they go into, actually, I'm going to use these terms, and they're used interchangeably, but it can be confusing. When I say when I say private investors, I mean not the government investors, like, regular individual, non-government employees, private in that regard. And they go in and they'll, and the government will buy, stocks or bonds. But then, because the government has gone into, and I'm gonna use these terms differently now, has gone into the public markets, which includes stocks and all this kind of stuff, and has really crowded it.
Yep.
And or lending markets, and so on, the more public lending markets. Then what do these non-bank lenders do? These asset managers, they start lending in the private markets. So the kind of the real economy, direct lending, private credit, all these type things, small businesses, and all these type lending. So what happens is, it's interesting how you have these large macroeconomic, stimulus type things. The government comes in, it pushes out, it crowds out a lot of private investors, and then where do they go? Then they kind of go into the real economy. So I guess that was a bit long-winded, but some of those aspects of credit, they're part of what's called alternative investments. So it's an alternative to your 60% public stocks and your 40% public bonds. There's like alternative ways of getting these yields. And one of the things I like to do is think about, if you want to get a 5% return, Jeff, how can you do it? Okay, well, you can buy a government bond with a heck of a lot of leverage, but if rates go up, your duration, well, I won't get too in the weeds, but you have a lot of duration sensitivity there. You could maybe buy a high yield bond. You could maybe buy a stock with a dividend. You could buy commercial real estate.
To achieve that 5% return.
Yeah, depending on what it is. I mean, maybe you couldn't do Class A multifamily now, but maybe you could do something, industrial. You could buy timberland, and for instance, timberland. Yeah. So for instance, if you think about it, that's almost like a bond too. Because what is a bond? You buy something, you get periodic
coupon payments
or coupon back, and then you get your principal back. So what happens when you buy land? That's timber, like specifically growing trees.
Interesting.
You pay it out, then you receive your interest, which is the harvest, and then ultimately you can sell the land.
Hence, it's just like a bond.
It's like a fixed income instrument, and you think about it that way. Agriculture can be that way too, but you say, oh, what's its duration? So for instance, when you cut trees, actually where I grew up is they have timberland. I was really getting involved in this. And
yep.
Anyway, so whoops, I think I lost you. Anyway, so
yeah, no, I can still see it.
They that cycle might be every 7 years you do a trim, or every 15 years. For instance, if you buy an apple orchard, I don't know this off the top of my head, but maybe that cycle is every 3 years. You buy, so there, it's
that's the duration sensitivity. Is that correct, Robert? Or?
No, that's, well, for like an apple, it's whenever they do the harvest, because what you're thinking about is how you're going to get paid. You're just thinking about cash flow streams, what you pay for the asset, and then when you get cash flows coming back to you, which could be coupon, it could be dividend, it could be rental payments from multifamily, it could be the selling of apples for the harvest. So I'm not trying to be too obscure, but if you kind of take a step back and think about things in a kind of a relative value way, you can think about, I want to get a 5 or 6% return. Where are the best ways that I can do that? And so that's like a larger example of how you can holistically think about, I find some people say, oh, I can only get a 2% return because 10-year treasuries. I'm like, well, there are other ways. There are alternative ways.
And that's the alternatives. Is that correct?
Yeah. I mean, that's an example of alternatives.
Interesting.
Like one example of alternatives is real assets, some is real estate. I found some really interesting structures where you can get double-digit cash flow returns by buying certain properties in certain regions, and then with some of the vacation rental income.
So that is the real economy, like what you said.
The real economy. And so it's interesting. So I guess we're coming a little bit full circle, but part of me spent so much time on Wall Street and got out into the real economy. One, people need help. Two, I feel better, in some ways connecting and helping with people that you can meet see and work with. Sometimes institutions are quite big. I did love that work, but I really love getting out in the real economy and working with people. And I'm finding increasingly as you're empathetic and you talk to people and are trustworthy, they really open up. And I'm finding all these incredible ideas, like for instance, some related to small businesses and restaurants with cash flow that are looking to do some land related transactions. Others, for instance, you might have someone that, and there's ways you can also combine insurance. When you combine insurance, a lot of people think about that as protecting your life, but you also can get guaranteed income through some of these policies, and it's tax free. So there's lots of little interesting kind of tricks. So you might say, all right, well, we talked about a lot. Well, now how would you do something like that? Well, would you like to have a little bit of guaranteed tax-free income? Call it, 4 or 5%, something like that. Maybe you want to have a chance for some decent upside. So maybe you want to put just a little bit into crypto, like a Bitcoin or Ethereum, something along that line. Call it digital inflation. You broadly probably need to be in stocks. I mean, because and so of course I agree with ETFs, and how they'll do that is maybe 50% or 60% of your portfolio still is traditional, with stocks and bonds. But do you want to be in S&P? Do you want to be in the Russell 2000 in the US, Europe? There's a lot of decisions in which ETFs you're allocated to. An interesting thing that I learned, Jeff, is a lot of the returns, people think it's like picking the greatest stocks, and you can have some home runs for sure, but it's really that top-down asset allocation. You got to be fishing in the right pond. If you buy the very best treasuries, or if you buy treasuries and when interest rates are going up, they're going down,
the price goes down, inverse relationship.
Yeah, that's right. So asset allocation, being in stocks in the years that, not everything goes up every year. Over time they do, but not everything goes up every year.
Robert, the market always goes up.
Years they go up, and yeah, exactly. So anyway.
Yeah. Wow. If we take a step back, Robert, what are we hoping to achieve? Like, I know this might sound philosophical, right? But what is the fascination with return? What I'm trying to say is that
it's time, right?
Yes.
It's time because and what I mean by that is people say, oh, you mean time value of money? No, that's not what I mean. What I mean is that I'd like to think I still have more than half of my life left, but I've spent a lot of years on this earth already, and I realize that a lot of jobs and a lot of things you do are you're kind of trading your time. And
you wrote that on one of your responses.
It goes so fast. It really does. It goes so fast, and it's funny. A lot of times people will be like, "Oh, I don't want to do this." You have to do something with your time. You can't just be like, "No one controls what I do," and just sit around. You've got to do something, good and productive with your time. But I think that when you have diverse sources of income, then all of a sudden you're more in control about how you want to allocate and spend your time. You can also, if you're fortunate enough to be able to care for others and provide charity and have an impact broadly with your money, I think that's fantastic. I think that, I would hope and love that everyone could have some impact, and even if it's through goodwill, or I don't mean goodwill, I mean in terms of like an accounting term, but I mean like just doing good. It doesn't always have to be monetary based, but doing good. And I find that if you can, a lot of people worry about money too. So if you take some of that worry out of the way, and you kind of know that you're kind of on plan, and you have some other tools at your disposal, and maybe someone that will provide you a better menu of options, then all of a sudden maybe you don't have to do that thing that you hate because you have these other sources of income, or maybe maybe you can do that thing that you really want to do because you have this. And so that's what I mean. That's what I mean, how it kind of, that's the goal. And
so to you, Robert, obviously, like I said, you've been in WallStreet for quite some time now. I know this is a very open-ended question, but if you could summarize for me one sentence, what do you think the meaning of life is? Because I think you touched on it already, right? Helping people, empathy. But to you personally, I think COVID has changed a lot of us. It's definitely changed me. I wouldn't be the person I'm right now if it weren't for those bumps. And one of the biggest things that got me during COVID was that I looked at myself in the mirror and I realized I turned into someone else. And I hated myself for that. And me doing this is me getting back out there and finding myself again. And it's beautiful. Now, I don't know what tomorrow is going to be like. I don't even know how this podcast is going to perform in 3, 6, 9 months' time. But I can tell you right now, I'm loving this conversation with you.
Well, thank you, Jeff. I appreciate, it's amazing how that I've loved this conversation too. And it sounds a lot's changed for you since COVID, hasn't it?
It has. And if there's anything that I'm very thankful for, Robert, was that I'm sure you heard this a lot about, you got to live life day by day. You can't think too much. You got to cherish every day. And I didn't get it. I don't get it. Like I'm 37 now, Robert. I don't get it. I never got it. But I can thankfully tell you right now, I get it now. I live my life day by day now. If I have a problem, it's tomorrow's problem. And I feel I'm in the present now. And don't get me wrong, we need money. I've got a daughter now. I've got a family of, obviously my wife, 2 kids. And in the past, I worried, how I'm going to put food on the table, what am I going to do with my life? But I can tell you right now, that doesn't hit me anymore because I'm enjoying it for what it is. And if it needs me to get back into the workforce or whatever, it's okay. I don't take things too seriously now. So getting back to that question for you, Robert, one sentence, what do you think that meaning of life is to you now, considering what has happened in the past 2 to 3 years? Because I know, I don't know what it was that when you and I first chatted about a few weeks ago, but I felt something and it compelled me to talk about this with you. And here we are.
Yeah, well, I enjoyed that conversation too, Jeff, and I really appreciate you bring me on.
Yeah, meaning of life, Rod, one sentence. I know by the way, we've gone 1 hour. We've gone a long time. So, one sentence, what do you think that meaning of life is?
I think it's getting to the place where you can find enough peace with yourself to truly want to help others and be happy, for them and for their success. Because I find that when you do that,
it's very selfless.
Then yeah, I mean, because I find that was the meaning of life. I mean, I guess in some ways it's self-discovery, and everyone will say, well, to help others, but life is temporary. It's going to be temporary for us all, and sometimes to say to help others, sometimes to say help others is a little bit like, well, who's to say that they need your help or what,
Yeah,
so
like who are you to tell me what to do?
Yeah, thank you for coming and saving me. But yeah, exactly. And I think it's like I look back at a lot of things that I worried about, and pleasing this person or pleasing that person, whether it's a boss or a family member or a friend. And I feel like I've learned so much, but I've lost a lot of time, worrying about what people think and external things and like that. So what's the meaning of life? I think it truly is it can be said being mindful or being in the moment, but I think it's exactly what you just said. I think it's being in that moment, being at at peace, and whether it's with nature or others. And I think when you're in that level, I find that like if you're busy and you're running for a train, it's hard to really connect with people. But if you're kind of at that level of peace, you can connect with people and see things and observe things in nature, and help others in a way that I think is really, really wonderful. My way of helping will be through finance or investing, but with the meaning of life, I think it's to find that level of peace, and that you're just kind of like just really at one and happy for those around you, and that type of thing. That's what I think it is.
You know, it's interesting you say that, Robert, because humans are humans, right? We're
Yeah.
pretty selfish. And the fact that you said that it's others, and that's beautiful, Robert. You know,
I mean, you even like you see something like, I mean, I think the war in Ukraine and with Russia is really interesting, and it's something that I don't think we've seen a war quite like that, with so much social media and so on. But like just the loss of life, I mean, it's amazing. I find that humans are we're like the mental animal. It's so amazing. Like it's unbelievable that humans can do so many amazing things, and we're the biggest threat to one another too. It's such a thing.
we are. It's crazy, hey. And you bring me back to why I'm doing this as well. I think we're tearing each other's heads off. We're becoming very siloed. We're categorizing a lot of things: left, right, progressive, conservative, liberal, labor, male, female, LGBT, black, brown, yellow. And one of the biggest reasons for why I'm doing this is that I think the world will be a better place if we just embrace diversity of thought.
Diversity of thought, 100%.
If we just sit down with Robert, we sit down with Jessica, it doesn't matter if she's brown, black, yellow, male, female. We've got two hands, we've got two arms, and at the end of the day, we all dissolve into the earth, don't we?
Yeah.
Yes. And don't get me wrong. I know. I'm always conscious of the time here, Robert. You're learning quite a lot. Obviously, like you said, you're no longer that 21-year-old, for example, and star quarterback or whatever, for example, right? What do you tell your kids nowadays, if you don't mind me asking, about how to navigate today's world?
That's a good question. That's a very good question.
Because I'm thinking about that too myself, and I don't know yet.
I think maybe the answer will be different by the time your kids get older too.
Maybe.
It changes so fast. I think that one of the hardest things I have a 17-year-old, a 14-year-old, and 9-year-old. The first was born when we're in London, the second in New York, and then the third in South Florida. And even among the three, like the technology changed, so much during that time period.
Crazy.
Like for instance, it used to be like with the baby monitors. Now, like you can the videos and so on. But like the fact when I don't know if you recall your dad, your mom might say, okay, listen, boys your age, they need to get 8 hours of sleep, so it's time to go to bed. All right, Jeff. All right, Jeffrey, let's tuck you in. It's time to go to bed. What if they're like, yeah, no, Dad, I just Googled it. It's only 7 hours of sleep. Like I got Google. So
you're wrong, Dad. You're wrong.
Yeah. So like, do you not believe in the science, Dad? You're like, well, it's harder, and also attention spans are harder and so on. So, yeah, it's strange. And, so what's going to happen in 10 years? Like virtual reality and stuff. Geez,
Metaverse.
You might have to be telling your children, you're like, listen, it's really important to meet people in actually real life too, not just in the virtual world. I don't know.
Like I'm very thankful that I think you and I, like, for me, half of me still has those teachings from my grandma. Yeah. The very traditional, be polite, listen, Always respect others, give them time, pay attention. Simple things, focus. That's it. Beautiful, isn't it? And then
Really is.
technology came along, right?
Yeah.
So, just as a side point, Ashley Barty, world #1 in tennis in the females game, she
Yeah.
retired recently. I'm not too sure if you follow tennis. And I had a conversation with my friend, and we're like, you know what? We believe it's definitely harder now for professionals looking at that space now to perform, because you can't just perform. You need to perform on social media. You need to perform with your sponsors. It's just no longer you on a tennis court.
It's so true.
And
And the way that you reach out and engage with people, and and that engagement on social media, and the fact that you're always so visible. You're right. And yeah, 100%. It's interesting. I remember, like, there's some musicians I follow, guitar players that I grew up as a kid just loving their music, and you get a magazine and you can look at everyone's show. But now it's interesting to see, like, the Instagram feeds of them just sort of like bumping around their house and making videos every once in a while. It's really interesting, the level of access. Um, it's unbelievable. Yeah. I find another interesting thing with kids is that they're it seems like they're a little bit less interested in scripted content. Oh, everything is much more user generated.
spontaneous, new,
Yes,
constantly
yeah,
evolving.
yes, yeah, exactly.
Is it really grabbing the attention?
Yeah,
And
people care a lot more about things like this, about conversations, real
I want to bring
conversation.
I want to bring it back. Dare I say, Robert? I'm very thankful once again. You hear me say thankful a lot, and I am thankful. I'm thankful to have a close group of friends where we pick up the phone and we call. Literally
Yeah,
call people, not texting, call. Um, uh, it can't be all serious, and we got to have a laugh, we got to have a yarn.
yeah.
So let me give you this sort of one last question, Robert, and
Okay.
just to break it a bit, because we've gone pretty deep, we've gone horizontal, we've gone vertical. Paint for me your retirement, Robert. Paint it for me. Paint a picture. I want you to be very vivid. Where are you? What are you wearing? Are you listening to something? Is there a certain scent that you're smelling? Are you with someone? Are you by yourself? Paint me a picture.
It's interesting you mentioned that. I don't know that I've visualized it yet. My dad's still 83 and still working. Well, I'll tell you one thing. Yeah. Where would I like to be? Jeff, I struggle because I love the beach, I love the mountains, and I also love the city. I don't know if I would want to be in just one all the time,
Hey,
but I grew up on the beach, so I think I'd want to be there. I'd want to be somewhere where, I don't know. There's something about retiring. I don't know if it's maybe just sort of the movies, but you imagine yourself like with someone you love, someone you care about, enjoying the sunset. Like, is that sort of how you think about retirement, or at least I sometimes do? What do I want? Do I need a lot of material things? No, not really. But I'd love to have some great experiences. I'd love to have a nice place where I can be around family. I'd like to have felt that, because I guess in your retirement, what do you really want? Do you need stuff, or really, I guess what you want is you want to feel like when you look back, so to speak, you put it all out on the field, meaning like
you
that
gave it your best.
you gave it your best, and you try to do right. I like to try and keep myself in as good a health as possible, and just really be engaged with the outdoors. Like I said, I grew up in the in the woods and the beach and all these areas. So I'd like to do that. I've never been to Australia. I've always wanted to go. I kind of view that like that I feel like I'm a similar spirit for sure. I feel like the Australian is maybe like the international version of I mean, some of the things that I really always loved. So I'd love to make it to Australia. I always love Yeah. So that's what the vision.
Sorry for all these tough questions.
No, I didn't. I'm sorry, I don't have a crisp
No,
answer
no,
on
no,
that.
you don't need
I
to.
guess
You
it'd
don't need
probably
to.
be near the beach. Yeah,
You
near
don't
the
need
beach
to.
with people I love, and doing stuff you love to do. I never want to be completely tuned out though. One thing is, if you ever had a busy job and then it ends, all
It's
of a sudden
hard.
100 emails a day, 200 emails a day to like nothing, you know. I'd like to still be engaged, so you're not just sort of like completely off the grid, but I'd like to be able to do it where um, it's a real joy to do it, not like
You keep the mind active.
keep the mind active, not like 8, 10 hour days, that kind of thing. That's what I'd love to do.
I'll tell you
Yeah.
what, Robert, tell you what. Now, the reason why I asked this question, because I'm a bit cheeky in the sense of I asked this question because it makes me think about what I want to see if it still holds true, despite having these conversations. So what's going to happen, Robert, is that
Yeah.
so I don't know, 20, 30 years time, you're going to fly to Sardinia. Okay.
Okay.
Okay. You're gonna live in this coastal town, and in that coastal town, there's this restaurant there. It doesn't have a name. There's this chef who basically just cooks whatever's catches the day. It's run down. There's no menu. You talk to the chef, and you ask the chef, "Hey, do you keep track of the news? Do you know what's happening in the world?" And the chef goes to you, "No, no, I don't care. I'm making lunch for you." That's me, Robert.
That's amazing. Are you making the lunch or are you
That's
receiving
me.
lunch?
I am the one making the lunch. I'm serving you. If you ask me for a menu, I'm not going to give it to you because I'm going to give you whatever I found in the markets this morning.
That's amazing. I love that.
Yeah, I mean, I'll probably check my phone maybe once a week for my kids in case they need me. But I tell them, if you want to come see me, fly over. No internet, nothing. Don't need a fancy car. Maybe they can live in the restaurant,
Yeah.
and by all means, it'll be great to have my wife with me, with whom I've known for 20 plus years.
That's amazing.
You know what I
20
mean?
years. Yeah.
22 and counting.
You met quite young then, didn't you?
Yeah, we met very young. We've been very young, and naturally, when you're young, you're an idiot. I was an idiot. I'm happy to say I was an idiot. I didn't know what I was doing, but I'm very thankful that my wife saw something in me, and she always saw it, and I'm forever grateful. So by all means, if my wife was with me, fantastic. As you know, in life, things don't work out according to plan. If she's there, that's a fantastic bonus. But that's where you're going to be. That's where you're going to see me, Robert. And
That's amazing. That's amazing. And I love the way you said that too, where, it's not the expectations of all, that's amazing. That's a great vision. Yeah.
and when the bill comes to you, Robert, there's by all means, if I was in that situation, there's nothing on it. There's nothing on the bill.
Oh, I thought you were going to say, inflation's high. I hope you invest well.
Oh no,
30 years.
I switched off already, Robert.
No,
I'm switched off. I'm gone. I don't know what's
no,
inflation.
I'm with you. I'm with you completely. That sounds amazing.
That's me.
That's a lovely vision. Let's make that happen. So,
Yeah.
all right.
So, any final remarks, Robert?
I think in my final remarks, I think this is while COVID was and the lockdown was really unfortunate in so many ways, I think that humans are really interesting in that we're adaptive. Once we like comfort, but we're adaptive, and that's when we really grow. And sometimes hard times create really strong people and really great people. And I think that's what's happening for a lot of people now. So
Beautiful.
yeah,
Robert, a pleasure. Until
Jeff,
next
thank you
time.
very much. I really enjoyed it. And thank you for inviting me.
Absolute pleasure, Robert.